What I want to do, I want to have an engaging conversation. So the idea is that the folks back home have just gone into to a wine bar or a British pub, and there we are sitting, and we're animated, and we're talking. What are we talking about? We're talking about the stuff that kind of moves the needle, and that engaging conversation between the two of us and sharing our passions is something that, imagine you could overhear that. Yeah, wow. And so what we're doing is we're inviting people to sit down, have a glass of wine, and listen. Acid Capitalist Show, Hugh Hendry. This week we have, I want to say, an enigma. Martin, are you an enigma? Martin Armstrong. Now, you just told me. I mean, I'm blushing. I didn't really think people thought of themselves as this, but he's an international economist. I mean, who calls himself an economist? I mean, that's like calling yourself a bishop in the Catholic Church, but anyway, not to get there. An advisor to governments. This comes, I mean, partly Martin, Mr. Armstrong is on the show because he's got a colourful background, and we like colour. We like life spent in the fast lane. So I've said so much that I want to end by simply thanking you for being willing to come on the show, and share some of your, let's be perpendicular. Let's be out there, and let's see what we can discuss. Clearly, we're going to discuss the here and now. Martin, tell me. Hello. Hi.
Well, the international economist is actually quite different. I mean, I was a hedge fund manager.
Oh,
and as a hedge fund manager, you have to look at the entire world.
You do.
And economists are typically just glued to whatever domestic things are there. And they don't understand really what makes the world function, how it works. I would say, honestly, back in the 80s, I was there in Geneva. We were all dealing with the OPEC money, etc. And then the capital began to move to Japan. And as it moved to Japan, the talent moved. So, the top brokers that used to be there in Geneva were suddenly in Tokyo. And so from an international perspective, you got to see how capital moved, the talent moved, everything. So like after, Japan, the bubble happened in 89, then everybody kind of looked, oh, Southeast Asia, that looks pretty good. Then they run down there. You saw the same thing even when Greece failed in 2010. All the dealers, they basically said, oh, okay, fine, we made a lot of money on that. What's next? Oh, Spain. Yeah, look at that. And then, oh, Italy, they're in the same boat. I mean, this is the way the world really functions. And the politicians tend to be just very myopic. I mean, they only look at domestic things. What can I, do? I've been, I would say this, that what really started my career was currency.
Mm-hmm.
Because back in the early 70s, they still don't even teach this in university. And
teach what?
Yeah, there's still the old theories of Keynesian economics, the fixed exchange rates. They still do not teach floating exchange rates and hedging in universities. Mm-hmm. I was there in London. I was asked by one of your top universities if I would be interested in teaching. And I went to lunch with him, and I was very shocked I said, I'm not really interested in teaching. And I said, why are you even inviting me? And they actually said to me at lunch, well, we know what we teach doesn't work. I said, well, that's a good one. But I got called in, I guess, when it started with 1973, where Franklin National Bank failed in New York.
Uh-huh.
And that was over a 7% move in the Italian lira. So
Yeah, within a 7% within a supposedly kind of fixed exchange rate. Yeah.
yeah,
Like
I mean, it was
had to be zero. 7 was a lot. Yeah.
So after that, virtually every financial crisis, they would just say, hey, get the guy that did that one, and so I'd be dragged into just about everything.
So
Even
what
when
did
they were
you were the guy that did that one? You were the guy that did what? They cleaned it up. That explained what had
pretty
gone.
much, nobody knew what was going on. They didn't understand how they lost money, where it came from. I can tell you, for example, we got called into all sorts of different things. I mean, the politicians do not understand the economy or how it functions. I mean, I was called in for.
Okay, how on earth are the politicians meant to understand how the economy and how the money works when no one in Wall Street understands it? I mean, I was in Miami last week. There was a lot of talent in Miami, but I met the wonderful David Zervos, and he invited me to come to one of his client dinners, and you had 15 of the great money managers. No one wants to talk about money. So let me bounce to you. I mean, your story is wonderful, but let's kind of let's try and be contemporary. So back then, that period, you were talking about the failure of the bank in New York in '73, and you were talking about Geneva. You're saying that's where the money was. That's where the petrodollar currencies were. And I want to say, if we go back to the early 1970s, that if we look at the Federal Reserve, and people forget this, first and foremost, the Federal Reserve is a regulator. It's a bank regulator. Yeah. On the side, it kind of moves interest rates up and down. But if you will, it regulates local onshore US deposit taking institutions. And those deposits are liabilities. And so those institutions create credits, they create loans. And in doing so, they create dollar money. And I want to say in 1973, that was kind of maybe 80% of money. And we're talking about money because everyone is talking about inflation. And the smart people know that inflation is a monetary phenomenon. So we got to get to the heart of the money. So back then, 40, 50 years ago, Fed money, I call it sovereign dollars, dollars created within the sovereignty of the United States, were pretty much the entire jigsaw. And so the Fed was kind of should have seen the entire picture. But what I want to say to you, that when you were in Geneva with the euro, with the petrodollar currencies, it was the emergence of the euro dollar system, which is the creation of non-sovereign dollars. There's dollars created out with the regulation of the Federal Reserve and out with the borders of America. And I want to say to you that today, sovereign or Federal Reserve money is no more than 25 to 30% of the picture. The big picture is what's happening overseas. And so to your point, the politicians don't see it. And that's kind of excusable, but the experts, the people that they've put as their interface to understand this stuff, they just insist on reading books by Fisher from like 100 years ago. So, so bounce back, give me your riff.
Well, that's the problem. The politicians, as well as the central banks, all right, they only look at things domestically. So a politician says, okay, fine, vote for me, I'll lower unemployment, whatever. They pay no attention to what's happening outside the United States.
Yeah.
All right. And they also don't even understand inflation. the type of inflation we have today is more similar to the 70s.
Oh, really? Okay.
Well,
Careful.
because OPEC basically raised the price of oil.
Sure.
Okay. Just arbitrarily. Now, oil was really, a fundamental cornerstone of the economy at that time. So it went through the economy, creating what they eventually called stagflation. All right. That is different than inflation that is created by a demand. Okay. Speculation, people hoarding toilet paper, stuff like that. All right.
Yeah.
So raising interest rates has no impact when you're dealing with shortages. It only, makes the entire situation worse.
Okay.
I mean, I had met with the Treasury in 1980 when they were bringing up interest rates to fight this kind of inflation. And, I met with them and I said, guys, I mean, this is crazy. At these kind of rates, you're going to double the national debt by the end of the decade. And quite frankly, they just said to me, yeah, Marty, but we'll be paying with cheaper dollars. I mean, there's just no understanding of the real implications of what they do.
Okay, but so let's keep with that. Right? Let's keep with that. So I take custody of your analogy. You're saying today, like the 1970s, the global economy is subject to a supply shock, not a demand. It's not like demand, well, kind of demand, a displacement of demand and supply created almost by the powers and the forces of something almost equivalent to a world war. The COVID, a global virus that waged war on the human planet, and we closed down. We paid people checks to sit at home. Don't come to work. Don't come to work. And then we sent them more checks to say, but spend money. And so we created this artificial demand against the backdrop of not being able to supply it. It's like, I've just closed the factory, and now now you're giving everyone money to spend. Okay, so you ration when supply and demand are out of kilter. Pricing is the function which brings them back. So too much demand, not enough supply, prices go up and the demand drops. You call that stagflation. I call that the that's where we see discretionary spending contract because people just have to heat their houses, they got to drive their car, etc. Okay. Fine. What should the Federal Reserve? So you're saying the Fed in raising rates, and I agree with you, it's not really a solution, but are they meant to do nothing?
See, that's the whole problem. The politicians want to be able to spend whatever they want. And they say inflation is not our problem. That's the Fed or the central bank.
Yeah.
So the central bank has no control over the spending. And their definition of money is very convenient. It's just, the dollar is created by the Federal Reserve, but that's not true. What really changed with Bretton Woods collapse in 71 was that if you had an E-bond from the US government, before then, it was illegal to borrow against it.
Yeah.
So the theory that it would be less inflationary if you borrowed because you could not use that for spending or leverage or borrowing. After 71, if you went trade futures, what do? You can buy T-bills and post them as collateral at the exchange, with your broker. So there's really no difference anymore between the debt created by your politician and that of the Federal Reserve or central bank.
Well, that's. I mean, I cut it differently, but it's the same central tendency. So again, I'm saying, think of the forms of money. I would kind of take the politicians. The idea of the politicians and the Federal Reserve, they're all just they're public servants. They're sides of the same coin. Okay. What I'd rather displace money in its forms between the money that is being created offshore versus onshore, or the money that's being created without the facilitation of bank deposits. So I think, like you say, the principal change in the 70s was that you could deliver treasury bills as collateral, and that would create new dollar bills. Okay.
Yes, it's whereas before you could not borrow against the, so in theory, the debt wasn't increasing the money supply. So it should not have been inflationary, was the old Keynesian idea. All right. However, when you allow the debt to be used as collateral, now you're creating money that simply pays interest. There's really functionally no different between that and the Federal Reserve printing dollars. So you've kind of crossed that line there as well. All right. And then what you're talking about is the standard leveraging of a bank. They keep, maybe 8% of the cash on deposit as cash, and then they lend everything else out.
Well, no, I mean, yes, let's pause there. So that 8% capital model is the onshore sovereign dollar money printing. Okay. And what I'm saying to you is that has become less and less important in terms of the definition of money. That's M2. This is this profound, infantile, why we talk about it, I don't talk about it, but why they talk about it is just silly. But it is the measurement of that 8% capital model. And since the near extinction of that business model with 2008, the risk appetite hasn't been there. And so the money creation hasn't come from that model. It has come from, again, to your point, the ability to use treasury bills as collateral to back the creation of new dollar bills. Okay. And that's a zero capital business. That's lending to infinity. That is taking the government out of banking, and that is the euro dollar system. And that money hasn't gone into the real economy. That money has gone into the asset inflation of the last 15 years. And that money is now shrinking. And my fear is that the Fed is not aware that outside its very narrow purvey, there is this monetary destruction going on. And the Fed, like you say, is fighting a losing battle, is trying to address the impossible with these interest rates when it was a function of, the treasury checks and COVID supply disruptions.
Yeah, look, when Keynes came up with his theory back in the Great Depression, the U.S. had balanced budgets. All right. So,
yeah,
to be fair to him, at that time, if you raised interest rates, we were the ones with the demand. Okay. And he said, okay, government should increase to a deficit to compensate for the decline in the demand from the private sector. So that was the theory. But government was never the perpetual borrower at that time. Once he allocated or sanctioned that, blessed it, whatever you want to say, then they have been basically running deficits perpetually ever since. Regardless if the country was in recession, depression, booming, it didn't matter. So honestly, the politicians today, they wouldn't know how to run for office. It's like, vote for me and I'll give you this. It's always bribing the population.
Is it? I mean, I hear that, and sometimes I agree with it, but I still maintain that you get what you vote for, and the democratic system that we have was, especially in Europe, it was created through the sheer rage, intense rage of the human carnage that came out of those world wars, especially the First World War, where there was still a division between the castes of our population, between the people with and the people without, and the people without were asked to sacrifice their sons in battlefield, and that rage widened the franchise, and people don't vote for hard money. They vote for politicians that create deficits when the private sector is on its ass. And why not?
No, I mean that's it. I mean, we don't have anybody that runs for office to say vote for me because I'm a better funds manager than the other guy. It's all basically just bribing for votes. That's pretty much what has come out of this, and eventually the system goes bust. And
Okay, but right. So let's play a game. Let's pretend that we can do whatever we want. Okay. So I'm running the world, and I've gone through the old telephone directory, and I was like, wow, Martin Armstrong, get me Marty on the line. This guy's an international economist. And I'm like, boo boo. I'm an old fashioned guy. Like, boo boo boo. Marty, can you hear me? And you're like, yeah. What's up? I'm like, what should I do? Okay, and like today. Okay, so let's define today. What's the problem with today in your world with your goggles? And if I hire you, how are we going to solve it?
depends who you are. If you're a if you're
I'm
a
the leader.
politician, all right, you're not going to want to hear it. I mean, look, I've gone to them. I've been in meetings. And I say, look, if we don't do this, this is going to fall apart in maybe 20 years. And the response is, yeah, that's very nice, but I won't be here in 20 years. So you don't have under this current system.
Sure, I'm giving you a clean slate. I'm saying to you, don't talk to me. Don't shush. Right. I'm saying to you, like, welcome to my world. Right. I'm in St. Boss. I run the country. I'm the boss. Okay. Carte blanche. Can do whatever I want. What should I be doing, Marty?
Well, basically, if you're the one that's creating all the money deficit year after year after year, come on, you got to stop it. You're relying upon somebody else buying your debt. What happens when they don't want to?
Okay.
That's what happened in London. Just if you had Yellen basically talking about the Treasury should maybe buy in the long-term debt and swap it with short-term. It's because you're raising interest rates. All right. What's the value of a bond that you bought just 3 years ago when the rates were negative in Europe? I mean, the losses are staggering.
Well,
but you're talking about destruction.
The gains have been amazing for 40 years, Marty. And we like what you're describing is 10-year has jacked up from 50 basis points to 350 basis points. Yeah.
Yeah, but the difference is this, is that when they lowered interest rates to negative in 2014, they did not look at the fact that most of the pension funds in Europe by law had to have 70, sometimes 90% sovereign bonds. You've wiped out a lot of the pension funds. Even if you take Social Security in the United States, it's 100% government bonds.
I don't mind doing that, Marty. I don't mind doing that. There's always two sides to a coin. Okay, so yeah, you're right. I am big on. I would have negative interest rates. Let me tell you why. Because there are debtors and creditors, and the good guys are the debtors, right? The debtors are the innovators, the thinkers, the crazy people. The Steve Jobs in his garage making a computer, right? Full of ideas, don't have any money. Okay, and the genius of our market economy is it brings them together with creditors like Saudi Arabia, China. In fact, Apple today is a creditor; it can't spend its money. And we create an exchange rate, an interest rate, a price of money, and from that we can trade, and we get an economy. My point to you is that the creditors, the pensioners, right, who've sat there with 10-year treasuries falling from a yield of 16 to 0.5, and with their managers doing volatility adjusting, which is to say owning lots and lots and lots of treasuries, right? they've done well. And now I need to rob them. This is financial repression because we got problems. And what I've got to make sure is that the interest rate for the innovators, the people that might change the world, I've got to give them access to money, and I've got to subsidize. I want the creditors to subsidize them. I want it. So I like negative rates because I'm trying to bring an economy which for 40 years has over rewarded not the rich, but those with a rich bounty and no idea of what to do. They've been overly rewarded. So there's always two sides.
But you're talking about the majority of that is pension funds.
Yeah.
And the problem there is that these people have counted on amount of money that they're going to retire on. And when it's not there, you're going to have millions of people basically with pitchforks storming the parliament.
If they've had a pension for the last, if you had a pension, if they're retiring now, they're retiring on a big pot of money, right? The problem is the kids who are living today, who in the 70s and the 80s and the early 90s, they could have aspirations, realistic aspirations of living in a metropolis, of owning a property in a metropolis. They don't have it anymore. That's why I'm saying the creditor class has been over rewarded. Indeed, the crime, I don't know if it's a crime, but the Federal Reserve has been compromised because periodically it's had to bail the creditors out. Asset values were on the brink of resetting to zero in March 2009. Fed had to do something, But in doing something, it's transferring wealth from the disenfranchised to the bloody franchised. It's complicated.
Well, yes, but you also have to look closely at what took place. I mean, most of that, the crash of 07 to 09 was the same scheme that a lot of the bankers have been doing for decades. They basically took mortgages, which should not have been pooled. They pulled them together, and every time you have done that throughout history, it always fails. But all they care about is how much they're going to make this year. That's it. They're not looking at the long term.
But Marty, explore what you were saying there. Explore that, because it's a good area. Because I want to link what you said. The pooling of the mortgage assets, the geographical dispersion of assets, the idea that you could lower risk. So first of all, mortgages are low risk. Like, people don't want to default on mortgages. They'll do a lot before the default. So that's a good thing, right? And then if you disperse the geography, there was a conceit and an arrogance that actually you were lowering the risk, because there had never been an observation where nationwide house prices or property prices fell simultaneously. So that was a theory, and it was an elegant theory. It was a theory that failed because we only needed one observation point to disprove it. And we got that in 2007, 2008. But what I wanted, the thread goes back to your observation in 1971 or whatever, where you could deliver the treasury bills as collateral. And actually what they were doing when they created those mortgage-backed securities, they were creating a collateral. They were saying these MBS are less risky than sovereign. They traded.
Yes.
They're more highly rated than treasury bills. And with that, again, you could go into the lending window of the euro-dollar exchange system. You could go to the international wholesale banking community and say, hey, I've got $1 billion of mortgage-backed security. Can I use it as collateral? Will you give me dollar bills? And they're like, sure. Okay. Mm-hmm. That was the thing that blew up. It was a disaster in the creation of fake collateral. That's what I want to say to you.
Yes, I mean, they leverage it all the time. And look, I saw it with, I don't know if you remember the Orange County.
I do, what, 94?
All right, now, it was the same scheme. Let's just leverage the interest rate. If you take 10 million, you basically leverage it out to 100 million, strip out the coupons, we can double your interest, and
we can make you rich, baby. That's what they say. Yeah.
I mean, I was an advisor, to one at the time, really, actually, to Temple University in Philadelphia.
Okay.
And the chairman was Dick Fox, and it was Merrill Lynch that tried selling that to their trust fund. And he sent them to me. He says, go talk to him. If he approves it, okay. And I looked at this and I said, guys, I've seen this so many times. I said, if interest rates tick up just 1%, you're wiped out. And they go, oh, but they're not going up. I said, really? All right. And these guys were like 20, 23, and they think they just discovered, the new way to make money. And that's basically what they told them.
Yeah.
They went back to Temple University, said that I don't know how to make the new way to make money, and that I was too old. And Dick, who's probably was 10 years older than me, he says, well, if he's too old, I'm really ancient, I guess. And he declined. But I mean, they blew up all these trust funds with this stuff.
Yeah. But you see again, to paraphrase what you're saying is like, the game is to create new forms of collateral, because there is a banking system which is unregulated and it has infinite leverage, but the only thing it asks for is collateral. Give me collateral. Give me collateral. And here we are. And like you say, your life is rich in these observations of times when collateral has been fantasy collateral is being created, and when the myth is revealed, then there's a crash in financial markets. And we've just done it again with crypto. I mean, I've been exploring and interviewing some people from there, and Sam Beckman, SBF, it's the same game. Like,
it's always the same.
The stable coin is a form of collateral. Okay. And what the allegation, which kind of rings true, is you only have 1% issuance of the stock of the coinage. So only 1% trades, and it's on your exchange, and it's like, and the price goes up, right? And so suddenly the 1% coinage is worth 20 billion. And you go to the credit provider and say, hey, I got 20 billion of collateral. What will you give me? Like, we'll give you 20 billion of dollars.
Yeah.
You just that thing, and it's just it's unwinding now. I mean, I was at a dinner where someone was saying, it's not like we've had any of these great financial crises, the LTCM, the New York banks blowing up in the early 1970s, et al., Lehman Brothers. We've not had anything. I was like, what are you talking about? We have just destroyed $2 trillion worth of crypto in 18 months. That's 10% of GDP. And then what you're forgetting is that's collateral. So that was probably supporting an eco structure of high credit risks, buildings, property development. Wow. It's the same thing from the 70s.
It's always the same thing. I mean, I had bought a house, and the guy needed cash. Why? Because he had, back in 87, he was big on buying all this stuff for, I forget what it was. It was all the medical leverage things back then. And he didn't want to sell his stock. So he puts the stock up as collateral to buy the house. The stock then falls like 50%. And all of a sudden the bank wants them to put up more money. He doesn't have it. It's always the same scheme. The instrument changes. All right. But it's always the same thing. And what I would say I've noticed throughout my 40-year career is that if you're at a bank, you made that decision and you lost. Okay. You get fired. Now they hire somebody else who then does the same mistake because he never made it before. You're better off keeping the person that made the mistake because he will definitely not do it again. But they fire them.
I like that.
It's just, I mean, we learned, we all took our finger, we stuck it in a flame of a candle, and our parents said, don't do it, it's going to hurt. We all do it, don't we?
Yeah.
So if you never, what happens if you, that's how we learn. We make mistakes in life and you learn and you progress. And, it's the old saying, gee, to be young again, but know what I know today.
Well, I'm the opposite. I was a really wise kid, and I'm a very irresponsible adult. I just got and apologies to the regular people. I had a catastrophe for my hair. I'd gone very blonde, peroxide blonde. Something went wrong, but anyway, in case you're wondering what happened, it was a mistake. So I understand, but you've got a letter. You've got everyone's got something to sell. You're selling your wisdom on a newsletter, yeah?
We don't charge.
Oh, it's free.
They can go to our website. It's for free. You don't even have to sign in.
What you're
like public service?
You're a public servant. Okay. So where do you? So how do you sustain yourself? I'm worried about you.
No, I mean, we have our own company we deal with institutions and stuff like that. But for the general public, our site, armstrongeconomics.com, is completely free. We don't sell advertising. You don't have to keep clicking all the ads off. And
very good. But then, so the institution. So yeah, you give it free, but then effectively you rob the pension fund via the manager. It's a good scheme. I don't mind that. Again, there's always a ways. But so what is so I'm managing $10 billion. I'm vacationing just now in St. Bart's. And someone told me that Mr. Armstrong is dope. He's the man. He's got the wisdom, right? So what are you advising people how to position their portfolios today? Or are you telling them what's gonna happen? What's your story?
Well, basically I started in computers back in the 60s. So I went through computer engineering, etc. And as a trader in the 70s, I realized I could write a program that would help with the hedging and everything else.
Okay.
And so I was probably one of the first people involved in artificial intelligence. I was even a keynote speaker for the American Hackers Association. But I created a program based upon my observation. So like I told you, like in Geneva, and I realized that there was no possible way to actually forecast the future from a gut perspective. We're all biased, whatever,
Can't create a time machine. The finance is absurd, right? All these super smart people guessing on an unpredictable outcome.
So I basically reduced it to a computer, and the computer basically monitors virtually everything in the world. And that's basically, it writes over 1,000 reports itself. There's no individual basically doing it, right, in full English, and we have institutions that around the world that use it, in central banks or whatever. I worked on how to hedge even like $1 trillion portfolios and stuff, and created natural hedges. And I mean, that's how I got to know Margaret Thatcher, basically. You're there in Britain.
Hanging out with Margaret Thatcher.
Her advisor, I don't know if you ever met him, but Alan Walters. Alan was a friend of mine, and with the Japanese, we would take their portfolios and say, look, we need X amount of assets in this currency, this currency, this currency. And the Japanese wanted to get into Europe, and it depended upon what they wanted. If it was the best tax deal, I put airlines in Ireland. Those that needed manufacture and the best skills, I was putting them in Britain, not Germany. And so I restructured a lot of the corporations in doing that, and using international finance and currency movements. And actually, it was Maggie Thatcher had heard somebody was sending all these people into Britain. And Alan says, yes, I know, it's Marty. And she said, you know him? I said, yeah. And so I went and met with her. Actually, she came and spoke at our 1996 conference.
Where did you meet her in the UK? Did you go to
in the UK? Yeah.
Did you go to the headquarters, the Downing Street, or
no? To the she had a place there in Victoria, I think it was. Okay. A white house. I remember going there.
Yeah, I think they call that Downing Street. But anyway, wonderful. What a great story. And so how did you, what was your impression of her?
Of all and I've met many world leaders. I would say she was one of the smartest. She understood much more on an international level than most of them. You know, you have to understand, you know, the press often is just very biased and will shift stuff one way or another. Yeah. I went to go meet Trump at his Mar-a-Lago when he was president in March 2020, it was. And he actually impressed me. And he wanted to pull the troops out of Afghanistan.
Do you think he listened to you, or did you have to listen to him?
No, it was both. He was, I think, because he was a businessman. He understood more on the international level than a politician. Mm. But what he had told me was that he wanted to pull the troops out of Afghanistan because he was tired of writing letters to guys who died to their parents to say that, oh, they died for God and country or whatever. And his remark to me was that, you know, I don't know why we're there. Why are we fighting in Afghanistan? They've been fighting over these borders for 1,000 years. And he said, quote unquote, he said, what difference are we going to make? And then you had Bolton calling him a traitor, this, can't remove the troops and stuff. But that's one of the real reasons they did not like Trump, because he wasn't one of them. And I was in Washington when the same thing when Ronald Reagan was elected. Now, he was a governor. And people don't understand this. The same thing then I heard, oh, we're going to have to train him. I said, what do you mean train him? He's not one. They like someone who's a senator or a congressman that knows, you know, the game. They don't like outsiders. Reagan was an outsider to them. So with Trump, you know, you look at Biden, you know, been in the Senate for all the time. Camilla, senator.
And a governor.
Pardon me?
Clinton, was he a governor?
He was a governor, yes. And also his agenda was really driven, I would say, by Hillary more than anything. But that's just the way Washington is. They're always skeptical of anybody from outside. It's a club. And I'm not talking if they're Democrat or Republican. As long as you're one of them, that's okay.
So, but again, I've asked you several times, and you have ducked and dived. I don't think you've done it deliberately, but I've asked you, like, you're making big bucks advising super smart institutions, right? You're an international economist, so you've got the you're seeing the big picture, right? And I'm coming to you today, and I'm saying, Marty, like, what do I do? What do I do, Marty? I've got $100 billion. Like, what do I do?
First of all, it depends. If you're an individual, it depends upon where you're at, what's your currency base, because it's always going to be different for somebody in Norway versus, you know, the euro. If you're talking about politics,
I'm a $1 billion family office, right? I'm living on the west coast of America. There you go. Like I'm okay. So stop running away. I'm $1 billion family office. Marty, what should I be? How do I protect my wealth here? How do I make my wealth go forward? How do I protect my ass? Come on, tell me.
Well, you're going to have to deal with, first of all, there's going to be a a shock as the Ukraine war expands. All right, you get an initial shock from that sort of thing. And then what happens is that you're going to have to stay in dollars, because that's how the United States even became the financial capital. It was because of World War I and World War II.
Yeah.
U.S. was a third world country. 70% of the population were farmers in 1850. J.P. Morgan had to lend $100 million in gold to the U.S. Treasury because it was bankrupt in 1896.
Sure.
And then because of World War I, all the capital came to the United States. Then after World War II, U.S. ended up with 76% of the entire world gold reserves. That's what made the dollar. That's what made Bretton Woods. All right. War has a very serious impact globally, and you can go back centuries. Capital will always flee wherever the war is, period.
Yeah.
You're not going to leave your money in banks with tanks running down the street blowing things up.
So
And
what is the escalation in the Russian conflict, the Russian-Ukrainian conflict? What do you mean by escalation?
look, we have to be honest here. What this is really probably a climate change war than more than anything. I mean, you have people that are deliberately trying to destroy the Russian economy because 50% of it is all fossil fuels. And that's really the sad side of this game. And
I'm sorry. What do you? Heavens, let's not be conspiratorial. To say that, no, do I even want you to say that again? So Russia is a big oil producer, and Russia is run by, it would seem, a cunning and very undemocratic and very cruel person who seems to have kind of overstepped the mark with the Ukrainian thing. You're not suggesting. What are you suggesting? Sorry, what are you suggesting?
I'm basically saying that there is no interest in peace. It can only get worse. That's it. Even the foreign minister of Romania just quit. He said the same thing. There's nobody interested in negotiating peace.
Well, okay. There are two parties. One party has invaded, run by a bit of a nut job. He's not interested. He's got, he suppresses his nation, and for the time being, he's feeling in control. And the other country's under the cosh and had a lot of its land annexed, and they're not interested in that. Makes perfect sense to me.
Yeah, there's no resolution here. It's just kind of like, you go to the Middle East. I mean, trying to get a resolution between Shiite and Sunni. I mean, it's just, you're not going to get it.
Okay, so let's take your point. So we have a war within almost the center of Europe, or to the eastern flank of, and so using your words, that creates a tendency for capital flight. Yeah. So
it's been part of the reason for the strength in the dollar recently. And you go to Asia, and you've got Biden saying we'll support Taiwan, and Pelosi hopping on planes and stuff like that. And then you have North Korea shooting missiles off and over Japan. Yeah. I mean,
but then, Marty, let's come back to our fantasy game. So again, I'm $1 billion family office, and you're now talking about war. I'm just trying to protect my $1 billion family office, right? So you said to me, stay in dollars. Okay. You've told me that the international theater is just a little bit too hot. Okay. So I'm keeping my money domestic. Is that what I take from you, right?
If you're an American, yes.
Okay. So I'm domestic. What do I do domestically with my money?
Basically, the longer term game in this is all private assets, away from sovereign government debt. I mean, it's what happened there in London is you have, with interest rates rising, long-term debt is basically leveraged. And these institutions are losing a ton of money on that stuff.
They are, indeed.
And that's why you had Yellen even talking about the Treasury buying in 30-year.
Yeah, you said
and
that.
20.
You said that. But let's try and see if we can make something
That's
out.
important. What she is doing is recognizing there is a problem with the yield curve, and that people want the short end, not the long term, because of all these uncertainties from war, whatever, in Europe and Asia. There's a lot of uncertainty out there. And when you have the uncertainty, you're better off with the short term than you are with the long term.
But yeah, who cares? Right? Who cares about Janet? She's whatever. Right? She's just like your grandmother. They're not, for all intents and purposes, right? The U.S. Treasury is not going to lock, stock, and barrel. It's not going to swap all of its long-term debt for short debt. It's not going to happen. So it's boring. Okay. Again, all right. I'm a $1 billion family office, right? I've got to. So I guess you're telling me I should be shorting currencies and long the dollar, right? I can get that, right? You're telling me kind of private equity, but private equity's dead. I mean,
not private equity. You're talking about mainly, if you look at the three indexes, NASDAQ, S&P, and the Dow. The Dow represents mainly the area where international capital goes to park. S&P 500 is more domestic institutions, and NASDAQ tends to be more retail. So just look at the three charts and you'll see. When the international capital is coming, the first thing that moves is the Dow. When the Japanese were coming in and buying all their property, they don't buy the house down the street from you moms and pops. They were buying all the trophies. Rockefeller Center. This is the way big international capital moves. They want the trophies. So they will go to the Dow before, and they're not going to buy a startup on the NASDAQ.
So you tell me I should buy the Dow because people are still crowding into dollar assets to flee the problems in the international theater?
As the international theater, you better pay attention to it, because as that increases, that's where you're going to see the capital move.
But you would be happy owning any stock market index when, because Janet's issue really is, hey, listen, debt is 4 times GDP. And that works when interest rates are 0 or negative in the extreme case of Europe. But when we start raising the interest rates, the whole thing blows up. And
yes.
London was a demonstration of that, right? So my feeling is that collateral unwind is going to persist, that banks just feel cautious. There was a story out today that all the major banks are like, we ain't telling you bad things are going to happen, but we're just saying we're a little bit fearful. So are you saying you should be in US equities, or do you think what is the probability of what's the probability the S&P has a 40% drawdown from its high in the next?
Not very likely.
And why? Okay, so why?
Mainly because you're also looking at the shift in capital from sovereign debt to private. A lot of people are looking at, look, first of all, Ukraine war continues. They are just dumping money in there like crazy.
Who cares? In the scheme of things, it doesn't matter. It's just
it matters psychologically. It's very important.
Tell me something else.
No, all debt always increases during war. Always. Sure. And you're looking at the same situation over in Asia. So the uncertainty of that has a lot of major institutions starting to shift already. They're not going to wait for the last day.
They are obliged, and they will be obliged to the very end. Like you said, the institution that is obliged to own 75% of his assets.
The pension funds, yes.
Yeah, the real money has the big, huge liquid pools of money,
So not all of them are that way. But okay. You have to understand there is this shift from public to private in addition to all this, craziness that's going on internationally. And you're not going to see, the S&P drop 40, 50%. It's just not going to happen. In order for that to happen, cash is going to have to run to government. Do you really want to buy more of their debt right now, when you see nothing but endless debt coming?
I would be more than happy buying their debt. I am not afraid with you could peddle that deficit story. You could have peddled that for the last 25 years.
I'm not talking about deficits. That's got nothing to do with it.
Essentially the classic economic orthodoxy that we were talking about, what the kids are being taught in school. Hasn't worked.
No, it doesn't.
Since the NASDAQ crash of 2000. Hasn't worked. Hasn't worked anywhere.
Well, the NASDAQ crash in 2000 was like the crypto, basically. They always get on to that. The same thing in the 20s, it was auto stocks. The new technology is always the big rush.
Yeah. Okay. So tell me again. You your history. You know your dates. We were talking about principally the agrarian American economy from the 1850s. Yeah. And I like talking the history. All right. And I think we're kind of in a depression, in that ever since 2008 we haven't reattained the growth rate that we had become accustomed to in the West. Okay, we're way behind. Like the deficit versus the growth deficit is trillions and trillions of dollars, and it's impoverishing people, and that for me is a depression. And we know from history that if it is a depression, it's only the fourth. They're very rare, right? You know that there was a depression 1820-ish, yeah. You know that there was one with the Agrarian Society 1870 in the US. That was a glorious depression, but it was a depression where the ordinary folk felt it. There was the depression of the 1930s, and there's a depression today, I say. Now, each one, it ends with a profound change in the politics, the politics of sovereign nations, how they engage with each other, how they transact. Like you said, we've mentioned Bretton Woods. We had a gold standard. Money changes. The money that regulates the system changes. I think we're pretty close to a change in the regulation. And I think it's going to come about because too much, if you will, fake dollars were created offshore using non-dollar collateral. The banking system saying, we don't want your non-dollar collateral. We want dollar bills. And so at the margin, you're selling another currency and you're buying dollars. We've seen that. I think that's going to accentuate itself, and America will come to reject. It'll be, I guess, like the Plaza Accord. And America will say, we got to get a 30% devaluation. And I think everyone will agree.
Well, you're skipping over, I would say, an important aspect. I would recommend you read Herbert Hoover's memoirs, which are now available online. 1931. Basically, what happened was most of all your countries there in Europe defaulted on their debt.
Sure did.
Yep. And Britain went into a moratorium, and it came out, but suspended its debt payments. But that's really what made the Great Depression so great. It was the default on the debts, because Goldman Sachs in particular was selling foreign government bonds in small denominations to moms and pops. And it was all wiped out. That's why so many banks failed. It was a different thing. That was not the stock market. The stock market went down because of the debt crisis. But there was a G4 in 1927, where the central banks of Europe got together with the United States, and they said, we have a problem here. And they talked to the Fed into lowering rates in 1927 in hopes of moving the capital back to Europe. It backfired. And the Dow basically doubled from there. The capital poured into the United States, and then Europe defaulted in 31. That's what made the Depression really that bad. And I think that's where we're going.
I think that's exactly where we're going. And I think you come into that story too late, because what people don't understand is, we began a long time ago this conversation about free floating exchange rates, right? In a free floating exchange rate system, no country runs a persistent trade surplus. China is running a trade surplus of 1% of global GDP. It's unprecedented and has done so for 20 years. The system, that shouldn't happen. And the fact that it's happening means that someone's cheating, okay? And China's cheating, and it's cheating because its currency is manipulated. Now, the thing is, if we're sovereigns and you're China and I'm kind of reproaching you for your behavior, you say, well, but you did it. America did it in the 1920s, because the system was that all of the money came into America. What was money, right? High-powered money was gold. And the crime of the Federal Reserve was that they did not allow that high-powered money to reach the banking sector, because to complete the equation, that high-powered money is like putting extra coal in the locomotive of the credit system. But the Fed knew that the US economy was on fire, and it didn't want to put more like coal into the blazing fire. But the theory was that that's how the system would have sought equilibrium, because the US would have had such a super, it would have been too exuberant, and costs and labor, America would become too expensive. And so then Europe would have a chance to compete again, and currency would be the swing factor. And that's why we got the Great Depression, because the Americans were cheating, and now the Chinese are cheating. And when sovereign nations cheat, things get nasty, things blow up.
Well, yeah, I don't think we're going to have our computer basically projects it to 2032. After that, I think we're going to have a new political structures, etc. The American Revolution was all brought, excuse me, about the end of monarchy, France, etc. all over. This time, I think it's going to be basically the end of republics. Maybe we go to a real democracy for once. That would be maybe nice. We will see. But I mean, we live in republics, not democracies. And the democracy, we should vote if we go to war with Ukraine or not, or Russia, or whatever. We don't make those decisions.
Indeed. So the computer says we're okay out to 2032.
For the political structure, yes, but it's extremely, next year is going to be, the computer is basically showing extreme volatility next year, war cycles. We're looking at civil unrest next year in particular on a global scale. You see a lot of civil unrest, I mean, not just in China and stuff, but I mean, as inflation rises and these people have pushed the price of fossil fuels higher in emerging markets and stuff, I mean, people, they don't have electric cars. They can't deal with that sort of thing. And, they need fossil fuels, and you raise the prices, they can't put food on the table. So you have a lot of people, rising up in protests in the various different places.
Money's too tight to mention, and the people are getting angry. Okay, I think that's a great way to. So thank you for all that. I can't let you go without, because, like, in the back of my mind, you've written a book about it, so it's all out there. But just, I mean, tell me about your time being a gangster.
A gangster.
I mean, yeah. I mean, you were incarcerated. I mean, they held you by. I mean, what happened? You lost your freedom. What was going on?
Well, basically, I've been always fighting against the bankers. When they do these manipulations, they're trying to bribe their way through and create the markets to do whatever they want. That all came to a head, and I can tell you that back in the 80s, I learned a lot about how capital flow moves and creates wars and things of this nature. We had the Universal Bank of Lebanon, and they had found somebody that wrote everything down in the daily prices of the Lebanese pound in a book back to 1850s. And they asked if we could create a model. And I said, sure, put it into the computer. And what came out said, their country was going to fall apart in 8 days. I thought there was something wrong. I called them on the phone. I said, look, something's got to be wrong with this data. It says your country's going to fall apart in 8 days. And very commonly they asked, well, what currency would you recommend? I said, well, it says the Swiss franc. 8 days later, the Civil War began. The same thing happened with the Iran-Iraq war. We had a client who was a big shipper out of Saudi Arabia. And he called and he says, what's gold going to do tomorrow? Iran's going to start attacking shipping in the Gulf. I said, you tell me a war is going to start tomorrow? He goes, yeah. What do you think gold's going to do? Over the years, that would repeat. And I began to realize that if you're going to invade a country, you're going to do it. Your friends maybe know it, and they start to move their money one way or another.
Yeah.
And so the computer was actually projecting wars. And your London Financial Times, I did a conference there in June of '98 in London. And somebody from the London Financial Times had snuck in the back. And I said, Russia's going to collapse. And I give it, maybe about 30 days. That was the whole Russian, crisis, the long-term capital management collapse and everything else.
But how come they threw you in jail?
Because the bankers were always trying to get me to go on their side. And I said no. So when that happened, and the London Financial Times put it on the front page, said, Armstrong says Russia's going to collapse in about 30 days. They lost a ton of money. And so they put me in civil contempt for 7 years. Eventually, I got to the Supreme Court, and the Supreme Court, ordered the government to explain what I was being in prison for, and they released me instead. So, because the maximum statute was 18 months for civil contempt. They kept me for 7 years.
What is civil contempt? Like the
judge tells you to do something, you say no.
Okay. What did they say? What was the allegation? I forgive me. I don't know, but I'm intrigued.
It was really quite astonishing that the bank initially said, oh, $1 billion is missing and we have no idea where it is.
Okay.
How can $1 billion be vanished from a bank and nobody knows where it is? It's absolute impossibility. You got to wire it out. You got to write a check, something, right? And they just used that. At the end, I mean,
taking it.
So what happened was I got a hold of all my clients. Everybody filed suit against Republic National Bank, which then became HSBC. HSBC had to plead guilty and pay all my clients back. And they had to release me. That was basically it. But it was Edmund Safra, who then was, they believe, was assassinated on December 3rd, 1999. And he had lost 50% of his assets in Russia.
Okay.
So it was all basically very complex. That book that I wrote, I got a hold of the declassified documents out of the Clinton administration. And people don't realize, but when Russia fell in 91, what happened was NATO actually invited Russia to join. And that's when the hardliners staged a coup against Gorbachev, if you remember.
Yeah.
And because they saw it as Russia surrendering to the United States or NATO. And that's when Yeltsin basically stood on the tank. He became president. And most people don't realize how Putin even came to power. What I was in the middle of, they were trying to get me to put in $10 billion to invest in this Hermitage capital. And I said no. And one of the main oligarch, Boris Berezovsky, who died there in Britain, and he was trying to take over Russia and wanted to become, the president, basically. So he had promised the New York bankers that if he did that, what would happen would be they would get all the gold, the silver, the diamonds, the oil, everything. And that lit up the eyes of the New York bankers, led by Edmund Safra. And that was really it. So then it was a plot to basically take over Russia. Yeltsin, the communists filed an impeachment motion against Yeltsin, trying to get rid of him for corruption. And then they would have reestablished the USSR. And then on the other side, there were the oligarchs who were trying to blackmail him to take over Russia. And all this is all confirmed from the documentation I got out of the Clinton administration.
Wow.
It was very interesting, but what is there, just what people even think of Russia, what went on, what's history. Basically everything we were ever taught in school was wrong. That just about everything else in school from monetary history was wrong. But that was really the bottom line.
Okay, I think I get it. It's all wrong. I think it's all, Marty, it's all wrong. In our world, it's all wrong. Listen, this has been wonderful. I'm sitting here, I'm looking at the waves, which are incredible today. And I've got to go. I mean, I think actually you got to get more sunshine about you. You got to get out there and take a few pina coladas and chill out a little bit. But I want to thank you. Clearly, you are the legend.
Yeah, I know. That's what they
Imagine being a legend. I don't know where your kingdom is, but for sure you're definitely the legend in that kingdom. And it's been a delight to pass the time with you. But yeah, I got to go, sir. I don't know about you.
Well, take care. Yes, I got a lot of work to do myself.
Say hi to that computer.
I will.
Thank you. I'll let you go. Thank you very much. Okay, take care.
Thank you. Bye.
Bye. Bye.